In this video, we're going to discuss the basics of a loan. And this applies to student loans and home loans, auto loans, and just about any loan that you can possibly get. To illustrate how a loan works, we'll use the following assumptions for our first example. And there's three items that dictate how much you pay in a loan, and that is the loan amount, the loan term, and the interest rate. And in our example, we're assuming a loan amount of $100,000. The initial term is 10 years, which is equal to 120 months, and the interest rate is 6.84%. The resulting monthly payment is $1,152.86. So in the finance world, we have what we call an amortization schedule. Now, you don't need to know what that means and what it is. You just need to know how it functions. And what ends up happening is you'll notice, first and foremost, that your monthly payment is actually split into two. The first is an interest payment, and the second is a principal payment. Now, we're going to first focus on the interest payment column. And there's a direct relationship with your remaining balance because the interest is calculated off of that balance. So you'll notice that as the remaining balance decreases, then your monthly interest payment also decreases. Now, the remaining balance is decreased by taking the initial balance that we start with, and then each month we subtract out the principal payment, and the result is how much we owe at the end of each month. Now, I want to compare this to a longer term loan. Oftentimes, this is important to understand because we can lengthen out the term of our student loans, for example, or we also might have to make a decision between, say, a 15-year mortgage and a 30-year mortgage. So in this example, we're assuming a 25-year loan, and that's the only thing that we changed was that 25 years. And you'll notice that the monthly payment then drops to $696 a month. So here we are showing the 25-year versus the 10-year loan, and you'll notice the major difference is that on the 25-year loan, in month number 1, you're only paying $126 each month to reduce the amount that you owe, compared to $582 a month for the 10-year loan. So we're going to fast forward out to the 5-year marker and the 10-year marker. And the key that you'll see here is that after 5 years on the 25-year loan, you haven't even paid $10,000 to reducing the principal, meaning you still owe over $90,000. On the 10-year loan, it's already been reduced to $58,000. Now, if you go out to the 10th year, you will notice that on the 25-year loan, that you still owe $78,000. That means after 10 years of all these payments, you've only reduced the principal by $22,000. Whereas with the 10-year loan, you have it paid off. So if you can afford to have a shorter term loan and your goal is to get out of debt as soon as possible and save money in the long run, then the shorter term loan would be better because you would end up saving and you would be out of debt sooner. The last piece that we'll discuss about just how the basics of a loan works is what happens if you're prepaying a loan. So we go back to our original example of the 10-year term, but we add in an extra $200 monthly payment, which means our overall payment is $1,352.86 a month. Now in this scenario, when we have the prepayment, you'll see that we added an extra prepayment column. Now what ends up happening is that we take our remaining balance, and every month we take our principal payment and our prepayment amount and subtract that from that beginning amount to get our remaining balance. So when you want to compare that to the 10-year loan without the prepayment, what you'll notice is that the remaining balance decreases at a faster pace when we're prepaying, which in turn decreases the interest payment at a faster pace as well. So that is the basics of how a loan works. And as we touched on earlier, the sooner that you pay the principal down on your loan, the sooner you're out of debt. And that increases your financial flexibility and gives you a lot of options, which you want when you talk about your personal finance. And in turn, it also increases your FitBucks score. Now, if you want some further information on your personal situation, just shoot us an email at info@fitbucks.com, or you can visit our knowledge center at fitbucks.com for more videos.